let's move on to your next approach, that is Moody, Galania and Miller approach. Now this particular approach was introduced by was first proposed by Franco, and then it was and Merto Miller, and their classic contribution in the capital structure. Okay, they have their classical contribution in the capital structure, which is regarded as most important paper on the modern finance. Now basically this stands as watershed. Okay, this particular approach stands as a watershed between old finance and essentially loose connection. It stands as a barrier between the two, that is old finance and modern finance. Okay, basically these are the two people who have introduced this particular theory. Now this particular theory has various assumptions. Okay, it has 6 assumptions, wherein it says there are no corporate taxes in the capital structure, no corporate taxes, perfect market, expected earnings of all firm have same risk, investors act rationally, the cutoff point of investment is capitalization rate, earnings are distributed to shareholders. Okay, after which it says the value of the firm is equal to its expected operating income. Okay, value of firm is equal. Okay, value of firm is equal to expected operating income divided by the discount rate. Okay, value of firm equal to expected operating income, which is completely divided by the discounted capital rate appropriate to its risk class. It's independent of its capital structure. This is the formula for this particular model, wherein R is equal to small r plus E is equal to O divided by R. R is the market value, small r is the market value of the firm, whereas E is the market value of equity, capital D is the market value of stock, and K is the discount rate applicable. Now there is revised M&M proposition. Now what is this revised M&M proposition? Is basically they have made necessary changes, wherein they've brought in taxes, bankruptcy, they've brought in various various points that they had missed in the previous they had missed earlier when they created this particular model. For your reference, you can have a look at this particular paragraph while you're studying. Okay, now there is also a historical background. Now all of this is not really important, but when you are asked, you need to have a general knowledge about what exactly has happened and why they have brought in necessary changes. And this particular model, okay, it considers 2 firms, okay, which are identical except for the financial structures. Okay, basically except for their financial structure, they are considering 2 firms which are identical, and how they are unlevered, and what is their financial leverage, and what is the partly equity and partly debt, based on the proposition they have taken into consideration. Now without taxes, they have this particular proposition 1, and with taxes they will have proposition 2. Okay, they will have proposition 1 and 2 with taxes, and without tax you have proposition 1 and proposition 2, and with taxes you have proposition 1 and you have proposition 2. Now let's look into consideration without taxes. Now without taxes, in your proposition 1, it says VU is equal to VL, where VU is the value of unlevered firm. Now price of buying a firm composed of only one equity, okay, that is known as the price of buying a firm composed only of equity, okay, which is composed only of equity, whereas VL is the value of levered firm. Okay, this is equal to price of buying a firm composed of mix of equity and debt, wherein the capital structure here is only equity and here it is mix of equity and debt. Another word for levered is greater, which has the same meaning to raise. Now to see why this has to be true, you need to just see what is the firm 2. There are 2 firms, that is ULN, and how you, instead of purchasing shares of levered firm L, he could purchase the firms of U and borrow the same amount of money. The firm which has the which has then equity or a combination of equity and debt, you can purchase shares purchase and borrow from that particular firm, purchase and borrow share from that particular firm. Okay, now based on this you have a particular contradiction. Now it also says it also says how L and price of L and U should be minused, and how the borrower B, and how he needs to check the value of that particular debt. Okay, now in your proposition 2 without tax, it basically is giving you a particular figure wherein you have 2 axes, that is the first here is K, which is showing you an upper curve of KE. KE is nothing but equity. You have your KO, KD is debt, and DE. Okay, this is the explanation of the particular graph which is given. KE is equal to KO plus D divided by E, open bracket KO minus KD. Now KE is the nothing but the required rate of return. Okay, KE is the required rate of return or the cost of equity. KO, which is the straight line which is showing, is the required rate of return of is the company unlevered cost of capital. That is assuming that there is no leverage in this particular thing. Okay, KD is nothing but the required rate of return on borrowings of cost of debt, and DE is the debt to equity ratio. It is a debt to equity ratio, how a company needs to have this particular ratio. Now, a higher debt to equity ratio leads to higher rate of return on equity because of the higher risk involved for equity shareholders in a company with debt. The formula derived for this particular theory is nothing but WACC. This is nothing but with when they are taken into consideration without tax, that is proposition 1 and proposition 2. Now these propositions, there are two propositions, that is with proposition 1 and 2 without tax, which are taking into consideration the two assumptions, that is no transaction cost exists and individuals and corporations can borrow at the same time at same rates. Okay, they can borrow at the same rates. The individuals and corporations can borrow at the same rates. The results, now what happens here is basically that is what they're teaching in this particular theory, and they are also the various assumptions have been violated, so because of which they have also introduced with taxes. Okay, now what happens with taxes is nothing but they again have proposition 1 and proposition 2. Now in your proposition 1 it says VL is equal to VU plus TCD, okay, wherein the full forms are as follows. Now basically here it means VL is the value of levered firm, VU is the value of unlevered firm. Okay, you are taking into consideration a levered and an unlevered firm. Now you have TCD, that is the tax rate, into the value of debt. The term assumes debt is perpetual. Okay, debt is perpetual. Now this means there are advantages for firms to be levered since corporations can deduct interest payments. Here you are taking into consideration interest payments also. Earlier you did not have tax rate, you did not have interest rates. Okay, they could borrow and lend at the same rates, but here you have interest payments, therefore leverage, lower rates, lower tax payments, dividend payments are not deductible when you're taking into consideration with taxes in proposition 1. Whereas in proposition 2 what is happening is it says a formula RE is equal to RO plus D divided by E, RO minus RD close brackets into 1 minus TC. Now RE is the required rate of return on equity or cost of levered equity is equal to unlevered equity plus financing premium. RO is the company cost of equity capital with no leverage. Okay, DE is the return on the assets. Now RD is the required rate on return on borrowings of the cost of debt. Now DE is the debt to equity ratio and TE is the tax rate. The same relationship as earlier described, stating, okay, this was the earlier relationship which was described, stating that the cost of equity rises with leverage. The cost of equity is increasing with leverage because the risk to equity rises. Okay, when you're increasing, when the leverage is increasing along with equity, then again the risk to equity is also increasing. However, there is the only implication for the difference of WACC, that is weighted average cost of capital. Now when it is increasing and decreasing, now whatever your optimal structure is, it increases to a point where debt is 100%. Now again this particular composition has proposition with taxes. It has two again. It basically has two assumptions again, which says corporations are taxed at the rate of earnings after interest. Okay, corporations, whatever the rate of interest is there, they are taxed after that, and no transaction cost exists, and individuals and corporations borrow at the same rate. Okay, the Miller model basically is following paper discussions of some of issues, and the theorem was proposed by F. Galania and Miller in 1958. So similarly, with this particular model, we come to an end of your third chapter, that is capital structure theories. In your next chapter, we will be starting off with your next chapter, that is dividend theories. Thank you for watching.